The idea of double taxation and this tax treaty that the US and Portugal have is thrown out a lot. But let's talk about what that actually means. What is this double taxation treaty?
Sure. So this is a document signed by the two countries to avoid people to paying tax twice on the same type of income. So that is the general idea. And many people do understand that because Portugal and the US signed this, or any other country signed treaty with Portugal to avoid double taxation, it means that they would not be liable to reporting income and paying income taxes here if their income is foreign source. That doesn't mean that at all.
Okay, good to clarify.
This document is specifically state how every type of income should be taxed. Which country has the sole right of taxing, which country has the first right of taxing or the second right of taxing. So that is what this document is. So basically, for example, one example I can remember is capital gains from property.
Okay.
So let's say we have property in the US. So they generate, if you sell the property, they will generate capital gains from property. But if you are a Portuguese tax resident, these gains are also liable to taxation here.
Okay.
So what you have to do is to balance the income tax credits between the jurisdictions, and you are left with the highest.
Okay.
So that is the outcome you are looking for when you are using the treaty. You are not supposed to pay tax twice. You are supposed to be left with the highest liability between the countries. But one thing is very interesting on the U.S. tax treaty specifically is on the bottom of the document, there is a disclaimer saying that the U.S. reserves the right of tax their citizens as if the treaty was never into force.
So what's the point?
So that's very funny. So that is why you guys have to file taxes both in Portugal and the U.S. Because you are treated as a U.S. tax resident as well.
Right.
Yeah. This doesn't prevent you from using properly the credits.
Okay.
It's just more paperwork.
Okay.
Basically. Yeah.
So it's possible that if someone has been living here for a couple of years, they kept their home in the U.S., now they've decided to sell it. They obviously have to claim it on both sides. And it's possible that they will be paying capital gains here in Portugal.
Yes, it is possible. So I do know there is a big benefit in the U.S. side for non-recognition of those gains if this was for a long time in the past your primary home.
Okay.
There's a set of criteria to do that, but if you are able to do that, you can, if you were a single person, you can waive $250K from taxation. If as a couple, you can double it. So you can have a pass on the US side on that of that. But on the Portuguese side, the gains are liable to taxation.
Okay.
You do have an exclusion of 50% that is included on the law for everyone. But if you're not under an HR or EFICI, you will pay taxes under progressive rates. But you will achieve exemption if you have one of those benefits.
Okay. So it's important to understand that the standard is you'll probably be paying, but there are some extensions that do exist.
Yeah, there are reliefs. As an HR EFICI.
Okay. Now, if someone has an income, if they're maybe like here on a remote worker job, what does that look like as far as the treaty? Like how can they, in their mind, be able to plan for taxes on both sides?
It depends on the nature of the income. For example, one can be a contractor or, can have wages. So basically it depends on the structure they have, if they purely have a foreign structure or if they are set to work in Portugal, have Portuguese wages or, Portuguese self-employment income. So depending on the source, and that should be defined on planning, depending on the source, you should be prepared to pay first where the source is. Okay. Basically, and this is very, very, very general.
Right, of course.
But you should be prepared to pay first at the source and then move the credits to the secondary jurisdiction.
Okay. So is that normal that someone, if they're an American citizen but residing here in Portugal, they probably will file first in the U.S. and then second in Portugal? Is that the normal way or?
It depends. Generally, for my NHR clients, what they want to achieve is to achieve, of course, the exemption.
Yeah.
Yeah. So basically, if they plan well, all their income sources will be foreign source, US source. So what you want to show to Portugal on that matter is, if you are in this specific situation, is that you have filed in the US first, pay all your tax due in the US, and then you're filing in Portugal and claiming the exemption. So that would be the most streamlined way to do that. But perhaps if you're not under an HR, or if you have at least one income stream in Portugal, it would be better to file an extension in the US to October, file and pay here, and then move the information to the US.
Okay. And once you set it up and then move here, are you kind of stuck? Like you can't restructure?
No, you can. You are able to restructure. And this, I'm talking about choices that you can do differently every year on a tax return.
Okay.
So yeah. So depending on how things go, if you change structure, if you change planning, you can you can adjust accordingly.
Is there anything else that you see with clients that there's a misconception of what this treaty means?
I think not thinking that they have to file taxes in Portugal because all their income sources are in the US. I think this is the biggest one.
So no matter what, actually, you have to file here. I mean, if you're a resident here, you file here. It doesn't mean you'll be paying, but you always have to file.
Yes, always have to file. Always have to, if you are a registered taxpayer in Portugal, always have to file. And if you were not a registered taxpayer in Portugal, but you perhaps have Portuguese sourced income, you do have to file.
How do you become a registered tax resident?
That is a tricky one, because usually, you know what the law says. You can be deemed a tax resident if you spend more than 183 days in the country, or if you establish your primary home in Portugal.
Okay.
But that is not automatic.
Okay.
So generally, and until now, Finances works on a self-registration basis. So generally, people become a taxpayer, registered tax resident in Portugal when they apply Portuguese address to their NIF for the first time.
Okay.
So that is...
So just having the NIF doesn't make you, right? Because I know that some people have gotten their NIF, but they haven't moved here yet. But it's like you have your NIF, you move here, you have your residency here. That's when you should then...
Yeah, so that's a long chain of processes because you do have to get the NIF for the immigration process. But at this stage, you have a non-resident NIF. So if you look into the paper you receive, you will see your home address on it. You know? And then you get the visa, you come here, you get the residency permit, and then when you receive the card, then you're able to register as a tax resident.
And if someone goes through the process, let's say in the middle of the year, but then, so they've got their NIF, it's their home address in the US, then they become a resident here in, let's say like October of a year. So that's when their tax residency starts. So technically for that year, they don't have to file?
Oh, they do have to file.
Okay, tell me.
Yeah, there is the possibility of filing a partial year. Return here. So you have to point out the date on your tax return in which you started, you register as a tax resident. And then you have to disclose all the income earned or paid to you from that date until December 31st.
Ah, okay. So you still should be doing something as far as like filing and okay. Now that you know about this treaty and what it really means, we actually have another video for you that goes into more detail about how you should file Portuguese taxes. So check that out here.